Welcome, guys. So, are we in a bear market in the stock market, or are we going to see a V bottom recovery? That's what I want to go into. What I'm going to do is go through some of the charts. It's over the weekend, so now we can really kind of analyze different aspects of the market and see if there's anything that we didn't pick up on or I wasn't able to pick up on during the week. I think it's important to take a retrospective look back at your charts and understand if there's anything that changed or if there's any signs or signals that we can pick up on. So let's get right into it. We're going to start off here with let's look at the Nasdaq futures. So this purple area is this range that we've been in. The levels, I'll just mark it out. Top 92.34.75 and bottom 89.57. So this is kind of the wider range basically that we've been in. And then we also have this middle trend line right here at 91. It's basically 91.11, 91.10.75, somewhere right in there. And you can see the futures on Friday, we crept up, overshot that 91.11, and then at the end just closed right at it. So that's either a breakdown or a successful test of resistance or support. I mean, as of right now, I guess you could have to say that it basically closed at support, and that's because of the previous candle overshot it. But that doesn't mean much. We could easily just open lower on Sunday night. There's really no way to anticipate that. So just understand we closed at a level. Could go either way, basically. It could come up to the top, could go down to the bottom. Let's look at the Qs. Qs was interesting. So if I look at the hourly chart, look where we closed. This purple line right here sitting at 223.33 is the gap entry right here. Look at the gap right there that we have. This is from the big February, March crash, basically. And we had this huge gap. And we were previously in the gap right here. So this, a couple of videos back, when I was looking at this, I kept pointing to this gap and saying the volume on this gap is extremely low, which doesn't make much sense for entering such a major gap right here. So to see super low volume like that as we enter the gap, that triggered me to basically tell everyone and anticipate that I didn't think we were going to fill the gap. And really, I didn't know at the time whether we'd fill the gap, but I just anticipated that we wouldn't because of the volume. So I used that sign to tell me that, okay, this isn't behaving like it should on a bullish move, which tells me that it will then create a bearish move. And that's exactly what we got. We sold off back here on the 12th and sold off on the 13th. And then had that was the beginning of the week, and then a little bit of a kickback rally towards the end of the week. And we closed, right there at the gap, at that resistance. So that's actually an objective area to short. And that's just because, you want to short at resistance. And this is major resistance. It's such a well-watched, easy level. We already failed up here. It was a false breakout into that gap. We failed. We've come back to do a back test. So this is an objective area to initiate a short. Doesn't mean it's going to play out, but what all you can do when taking positions is where I found the most success is take your positions near objective levels and then manage the trade, manage the risk. If it goes against you and starts to work its way against you, you want to read the charts as it's going against you to make sure that it's not just a fake out move. Look for signs, but you can cut your trade short or cover it, or if you're long, you can sell it and take a small loss. And that's important in trading, is taking small losses, because you're going to be wrong. Ultimately, when I'm looking for short trades, I'm wrong more than I'm right. It's just that when I'm wrong, I lose small, and when I'm right, I win big. And that's basically the concept behind that. So this is an objective area to short the triple Qs, 223.33, and we look for that to move lower. Now, what I could see on maybe Monday or even Sunday is they open up and gap up into this gap and it fails. It just would instantly sell off and fail. So look for that. If we gap up on Monday morning, maybe it won't be probably too much higher, but maybe just a little bit into this gap up, and then the sellers just step in and smash this thing, and we could get a pretty big move down. So that's a possibility. Or we just gap down. Maybe Monday we just have a move down and gap down. So I see those as kind of the two highest probabilities. The bullish side, well, okay, here's the thing. If we break back into this gap again, right up in here, if we start to trade back into this gap and have some consistent closes back within that gap, I would read that as bullish. Of course, I would want to look at volume, but I would expect volume to increase if we enter the gap again. Oftentimes, when you enter a kind of a pivot zone, if you enter a pivot zone and you fail, if you come back to that pivot zone and you're back in there, then you have to read that as strength and as bullish, because we don't really have any real business being back into this gap for very long. I mean, if we enter it, with an intra-hour candle, maybe it just gaps up and fails, or that's okay. It can do that. That's running stops, because you got to understand, people will probably be taking short positions on Monday, or they took them at Friday at the close. And so if they want to run those stops, they have to kind of chop around up into this gap a little bit before failing. So that could happen. But if we start to close hourly consistently with strength and maybe see some, strong volume, then you have to read that as bullish, and that will be, that will probably be enough to get us to actually, gap fill. And I think if we gap fill, we probably hit all-time new highs. And that's really, you have to look at it from both sides. So that's just what I'm going to see. I'm going to be looking for those different things. I put a higher weighting and a higher probability that on the bearish move that we move down, that we either gap lower on Monday, or, some news, they'll float some news headline out over the weekend. And then the market will, the market maybe is just looking for a reason to sell. So they'll just attach onto that news headline. Or a gap higher and then a failure. If we gap higher and fail, that's pretty bearish. A gap lower is also bearish, though, I guess. All right, so moving on, SPY. All right, here's SPY. I've got this 286.50, 286.40 is resistance. You can see some reactions right in here. If I scroll this one out, it's going to probably cover a couple right in there. Reactions right here, so that held as support. Then we gapped down below it. It was resistance. Then we gapped above it. You can see it's been a pretty choppy market. Up kind of. The bulls and the bears haven't really won the battle recently. And then we move lower, and then we kick back right to resistance. So as of right now, that's resistance. You have to treat it that way. And look at this trading range we've been in. This is the big trading range, but if you look, we've kind of got the lows down here at 272.70, and then the highs up around 293, 294.50, something like that. And we've been in this range really. I mean, ultimately, it actually goes back to right here, April 7th. So about 5 weeks. This is about a 5-week sideways trading range. It's been, I've been able to trade some of these dips and rips, but a lot of my videos, I'm talking about kind of the major moves, the swing moves, the next trending move. So when I put out a thumbnail or something that says market's going to crash, I mean, yeah, I do that for clicks, obviously, but ultimately that's kind of my thesis behind the big trending move. Whether we rip up and move higher in a week, doesn't negate my larger term thesis that we are in a bear market. And so just understand that, if I put out you could probably go back 5 weeks and stuff, and you'll see I'm putting out headlines saying markets are going to crash, or thumbnails. And yeah, okay, we haven't crashed within 5 weeks. That doesn't mean we're not going to crash. That just means we're consolidating, moving sideways. I'm looking for the next directional move like this big move. And so I think it's going to be something like this. But again, that's just my thesis. I've got data behind it to back that up, but and I have charts telling me that's going to do. But just understand that it's impossible for me to call every single move every single day, or even the week. I don't I can anticipate where I think things are going. Doesn't mean I'm going to be right from week to week. My larger term thesis is down. So over time, we'll see if I'm right on that one. So again, SPY at resistance on the hourly. What would I look for? Well, I'd look for a move down to the lower range, 272. Right around there. Usually, a lot of the time when you have this channel and you have this kind of middle of the range trend line, price channels oftentimes will create some sort of a middle of the range reaction point. And a lot of the time, you'll notice whether it's an upward channel, a downward channel, or a sideways channel, that middle of the range pivot point, when you trade above it and you come down and tag it, you'll kick back up to it. Kind of like this. You're above it here. You came back down, tagged it, gapped right up to the top of the range. Came down, didn't tag it, gap below it. Well, we didn't move down there, but this one we moved down, we come back. So, whenever you do that, there's a higher probability that you're going to go like this, either gap down or move lower throughout the day and test the lower end of the range. So I think that's probably what's going to happen next. I think we'll go to the bottom of this range before we go to the top. But again, I'm not sure. I'm just putting a higher probability on that. Someone in the comments asked me where I think markets are heading, and I'll just show it again. I haven't shown it for a while. Here's where I think markets are heading in the next move down. This is 212 on the SPY, and this is 187. And I think we're going to get down into this range area. I don't know exactly where, but I think that's the next leg down, possibly the lower end of it, 187. That goes back to the 2015, 2016 trading range. We had a big deer market right back then. A deer market, if you're not sure of what that is, that's a sideways market where it doesn't go up, it doesn't go down, it just goes sideways. And so that's the deer market from back then. And I think that we're going to trade down to that range on this next kind of bearish leg down. Now, if we get that move, obviously that confirms the bear market that I think we're in, and we will be, we'll be deeply in a bear market. But I do think that's where we head. So, and that would be kind of your C wave. So this is your A down, your B up, and then your C would put you down, maybe down to here. So I don't know whether it's going to, a lot of people are saying it's going to be a double bottom. I think it's not, I think we're going to undercut the lows and actually head lower, down to something like this. But we could easily get down to 211. We'll probably have some sort of a reaction right around there. Maybe a 5-week long reaction before making our way down. Again, that's just bigger picture stuff, and that is going to take time. So, when markets crash, this was an extremely fast crash right here. This, going back here, when we had this first leg down, this was the fastest crash, I think, of all time. And don't expect the next leg down to be this impulsive and this fast. Because the thing is that this was the beginning, we were in a bull market for a while. I mean, we were grinding higher. So a lot of people thought we were in a bull market. And so there was a lot of repositioning, and people were running to cash. People were, margin calls were being fired off like crazy. Basically, everybody who was over leveraged and completely off sides on this move got forced out and created this big leg down. Now you would expect to see more of the institutions are probably at least more balanced. Maybe they're still net bullish or net long, but they're probably a lot more balanced in at least anticipating that there is probability that we can move lower. I know some of my family and friends have are holding on to more cash as well. So yes, they are. Most retail people that I know are bullish, but they are still holding on to a little more cash. So just something to keep in mind. I don't expect it to move down as quickly. I think it'll probably work its way lower although moving a lot faster down than the market would move up, but not as fast as this. So just something to think about. All right, XLF. So this was one of the main reasons for the rally on Friday. The banks were extremely weak on Thursday, Wednesday, and Thursday. I kept pointing it out, saying this is not good to see such weakness. Well, we had, the buyers stepped in and bought up XLF. Not really at a level that I see. I mean, I don't see an objective, a huge support level as to why they stepped in right there. But the market just decided this was the time to buy it up and do a kickback rally. But here's resistance. We're going to move it. We can just move it. It's about right there, I guess. And we just kicked back to resistance and couldn't break resistance. So all the move back, all the strength in banks on Friday still had a down day, still closed lower, and just moved right into resistance and couldn't break above it. So not necessarily a bullish move, just a kickback move. And that's the thing. In bear markets, you're going to have kickback moves. You have to continue to make it, you have to continue to make it difficult for shorts to think that they're in a bear market, and you have to continue to suck in bulls or longs in order to fuel the bear market. You need people to take the bullish side of the trade so that if it goes against them, they start to take on losses, and then they become sellers, and that's what fuels the bear move. So in bear markets, there's always points of equilibrium where you don't exactly know if it's going to go higher or lower at that moment in time, that equilibrium point, and that's taking on the fuel for the next move, whether it's bullish or bearish. All right, so let's see here. Let's look at the daily here. See, I don't see anything that tells me that was a reversal move. So, I mean, that's another thing. When you have like a down move, sometimes you want to look for some sort of a bottoming move or a reversal move. This was this candle right here, the day before, it looks like, was a bullish engulfing candle. So you can see that we, engulfed the previous bearish candle completely, but we didn't get follow through the next day. This candle right here is not confirming. So that's the thing. When you have a candle, a bullish or a bearish engulfing, you want, in order to add to the case you're trying to make, you want to see a confirming candle. So something like this. Look at the cues. If I go to the daily here, you'll see, look, bearish engulfing candle on the daily right here with confirmation the following day. That's what you want to see. This tells you that it's starting a trend, that it's a trend change. Now, it doesn't mean that it always holds. Sometimes it doesn't, but it just gives you a higher probability. And this trading game is all about playing the probabilities. So you want to put the probabilities in your favor and then take your trades around objective levels. XLV. So this is the third important sector. So basically we've gone through tech, we've gone through financials, and now we're going through XLV. XLV, bearish engulfing candle on the hourly, sideways trading range. And that's really all there is to it. There's nothing else to really look at here. So there's nothing to say that this can't go up or it has to go down. Ultimately, I put the probability that it goes down because we had the bearish engulfing wedge, and that bearish engulfing wedge broke bearish. We broke bearish and then chopped sideways. So this was a sell signal here. If you took the sell signal, you've pretty much made no money. You've just kind of, you've been positive, you've been slightly underwater, you've been positive, slightly underwater. But that's the other thing. The risk reward, if you took the sell signal right here, you've, went and you've held it, you've been underwater 1.5% about right there. You were underwater roughly, 1% on this peak right here, and you've been positive 3 to 4%. So roughly a 3 to 1, 4 to 1 in your favor when it's been positive. However, I'm short this, and I'm not looking for this sideways price action. I'm looking for a bigger breakdown. So that is what we're going to have to evaluate as it comes. We can mark out some support levels. Let's see if we can find them. I haven't, I'll have to probably do a little more homework. That's possibly one. Yeah, I'm not going to be able to. Yeah, somewhere right in there. That's definitely one right there. We'll just I'll leave that one up. 90, 67. I'll do a little more homework. And one way that I really try to find the levels, rather than just, I try to look for lots of reactions around a trend line or a horizontal line or whatever. I'm looking for a lot of reactions. And then what I do is I'll go through and look at the volume spikes, especially on the daily. You want to go through and look at the volume on the hourly. Look for reactions and look for volume spikes around those levels. So, like right here, we held support. Now we didn't really have a volume spike. So you want to look for that kind of stuff. Here's a volume spike right there, came right up into that. So look for reactions and volume spikes around those reactions. That will confirm your trend line, or at least help you confirm it. Just a little tip there. Semiconductors, they had an interesting day on Friday. They were lower by 2%. This is the SOXX semiconductor index. And the semiconductors were weaker on Friday. Now, and semiconductors oftentimes are kind of the bleeding edge of tech. They'll run ahead of tech, the larger tech, large cap tech, and they'll indicate where tech's going in the future. So that's just something, it doesn't always play out, but that's something that, a lot of professionals and the industry in general kind of watches for. So tech was down. Semiconductors were down. Large cap tech was down, just not nearly as much. So what does that mean? Well, we'll have to watch and see. But as of right now, we've got obviously this bearish rising wedge that's been in place. We broke bearish. So here's your break. And again, same situation where if you took the breakdown, here's the breakdown right here. You basically broke down on this candle right here. If you shorted that breakdown, then you were instantly rewarded with a profit on the initial move down of a 6% gain. And then we had a kickback rally, and if you held all the way through because you're looking for a bigger move, you were down, 3%. And then it moved down again. And from there, you basically had a 5%. So you can see that even though it's gone against you, it hasn't gone against, it's been in your favor a lot more than it's gone against you. So risk reward still looks good to the short side. But it's again, it's all about positioning. All right. And that's why I put these videos out, drawing these big bearish wedges and trying to anticipate the next move, not the move it's in right there, but the next move, especially when you start to get to kind of a mature bearish pattern. Then I look for the next move, because if you can get positioned correctly, get a good entry, then you're set up for a good risk reward trade. You're not taking on as much risk, and you have the potential for a better reward. So it's all about positioning. And a lot of the time what happens is I get haggled a ton by when we're in like a bearish rising wedge like this, and I'm looking for the breakdown. So I put out videos saying, okay, I'm looking for a breakdown. This should break bearish. I get haggled all the time by people that all they see is a trend moving higher and higher. They don't think a bearish rising wedge means you're going to get a breakdown or anything. They just say the trend is your friend, ride it. You shouldn't be looking for a down move. You should be buying this market, things like that. And then, if I do that, fine, there is sometimes profit to be made. But ultimately, if I'm not looking for that bearish break, then I miss my opportunity to get a good position. And then if I don't get that good position, then your risk reward is potentially off. Maybe you got short right here, and if you got short right here, then you haven't been rewarded for shorting right here. You were late to the game. The short was right here, right when it broke. The people that spot the reversals or the trend changes early are the ones that get rewarded. and then you know, these people might get rewarded at some point in time, but they have to wait for this thing to break. Where oftentimes if this is breaking, I'll be covering some of my short position, taking some profit, locking in some gains, and then I can keep, you know, a partial of my trade to become a runner. So that's just how I like to do it. That's just some tips on that. Oh, Mr. TVIX. Let's look at this one. So TVIX had a great trade on this last week. I pointed out in a video that we undercut right here, the trend line support. You can see it. Here's your trend line on the hourly chart. And then we recovered that trend line. So that basically was a false breakdown. That shows you that that was running stops, you know, making people think it was going to break bearish, but then popped up. So, and volatility is for the most part inverse to you know, stocks. If stocks move higher, volatility moves lower, and vice versa. It's not always correlated, so I don't trade it exactly like that. But what happens is you'll get an impulsive move in TVIX when you usually start out the inflection point of a trend change. So if there's a trend change in let's say stocks are moving up and they're just grinding higher and higher, and then you get that initial impulsive inflection point where all of a sudden stocks change trend and start to move down, you'll get that big spike in volatility at that moment in time, and then maybe you'll get some follow through, but for the most part, that's how TVIX reacts, is based off of initial impulsive spikes of people buying puts basically, or so that's what we got. We got that initial impulsive spike when the triple Qs and everything broke early last week. And then, so this thing was a runner, from the low all the way to the high, 70% gain. I captured, a good portion of that. I didn't get it all, but I got a good portion of it. I started adding down here at support right here. So I bought a position here. I added a little bit more when we started to head back up and recover. And then I caught a big pop all the way up to the top. I sold that around 224. I was looking for this. I was looking for 245, 246, somewhere right in here. That was a trend line. We didn't quite get it this time, but it got really close. I saw things starting to kind of top out in reverse. I cut my position. We were close enough to my profit target. When it started to kind of go against me and sell off, I just took that profit. So that was good. And I do think we get another pop, and I think we probably at least hit this 246, but we'll have to watch. Again, I use TVIX to capture that first inflection point, and it's correlated with my trading style, because when I'm looking for things like, if I look at like bearish rising wedges, then when we get a break right here, I might grab some TVIX too, looking for that first initial volatility pop. And then if we break down like that, you'll get the volatility spike. I sell my TVIX, lock in some profit, add it to the piggy bank, and and then that allows me to keep my short trade on an index or something, continue keeping it on, looking for the bigger move, because I'm able to lock in some profits on some smaller moves or volatility spikes and things like that. All right, what else do we want to look at here? Let's see, Apple. Apple broke this trend line. We had this trend line right here. I kept saying that we're no longer impulsive. Look at that. It was just grinding up this trend line for the longest time, and then we failed. So I think there's more downside here in Apple. Probably going to come down to this 293 level, chop around there maybe a little bit, and then, possibly move lower. We'll have to see, really. Microsoft, we had this bearish rising wedge, broke to the downside, and we've just been doing these kickback rallies in this secondary price channel, and we just started kind of ramping up, right here on Friday, but still within this price channel, so nothing to really write home about. We could pop to the top of it. It's hard to say. Tesla. This thing's been a bear too. It's been trading sideways, basically, a lot like the SPY, and closed Friday right at resistance right here at 801, 802. It's a $800 stock, so it's hard to get it exact, but it's basically 802 to 804. Let's just say it's within that range. And we closed right there at resistance. So that should move us down. However, we've popped that resistance a couple times, popped it here and failed, popped it here and failed. Kickback rally. Now that tells me we work our way down to the bottom and fill this gap. I am looking for this gap to fill. I think we're going to get there, 650. And yeah, I covered my trade the other day, but I did add back a half position on that. I figured that it's still acting fine. Since we did this failure right here and recovered back within the trend line, that is bearish. And so I do think we're going to get a gap fill. So I'm going to take a pop shot at this one. I have the data. The charts tell me that we're still holding resistance. We've got a gap to fill. We just need to see some momentum to the downside. We start to move up and work our way higher. I'll just cover that. But then again, it's only a half position for me. So, all right. And NVDA, this one's been on fire. I'm not long it, so that's a shame. But I was trying to analyze what we got going on here in NVIDIA. The semiconductors were, we're not doing well on Friday, and yet NVIDIA is basically kind of gone parabolic. Look at this hourly chart. It's just pretty much straight up. I think this was the blow-off move. That's what I was looking for, basically. And so here's what I see. I've got this bearish rising wedge here. Again, I make the bearish rising wedge by trying to connect the most reactions. So we had a reaction, reaction, reaction. We had a couple there. The top isn't that valid. So, I only have 2 data points. So it doesn't necessarily make a bearish rising wedge. And, it's just a trend line right here. And we broke to the downside, kickback rally, kind of set up, these kickback rallies set up another trend line, broke sideways. Then we created another trend line, on the hourly, broke again. Then we created this last final trend line where it just, basically went parabolic and came back and back tested that previous trend line right there at 339, 339.90 or whatever. And that's where we closed. So I actually took a kind of a smaller position, short right there at the end of the day. I just grabbed it right there. I figured we get a pullback, at least back down to this 324, possibly lower. So looking at that, just looking for that. NVIDIA's at all-time highs, so we'll see. Oh, and then also NVIDIA, look at the daily chart. We just closed the day pretty much right at overbought, right around 70 on the RSI. So that's not the be-all, end-all, but that just tells me that this we moved up impulsively right into resistance, closing right at resistance while overbought. That puts a high probability that was the end move of, or at least a topping, could be a topping move. Now what I look for is a reversal. If we don't get the reversal, we continue to move higher, then none of this means anything, and, then I'll cover my short. But I think the probability was good at the very end of the day that we were closing right there at resistance with being overbought, that I think we get a down move now. Okay, so it's a long one. I've tried to go into detail. We've gone through the tech sector. Tech was kind of neutral, but at the same time, we had this bearish breakdown right here, bearish engulfing with confirmation. So now we look for continuation of the bearish move. XLF closed at resistance, so that still looks bearish. Longer term bearish, and shorter term closing right at resistance. So that is not good. XLV is basically sideways. Got to give a little more weighting that we're going to get a bearish breakdown because of this bearish rising wedge pattern that broke, but it doesn't have to. We could just be creating a bull flag and consolidating sideways before making another move higher. That's always possible. So that one we'll just call neutral to slightly bearish. And those are really the top 3 sectors. Again, also semiconductors had a bearish move on Friday. Doesn't mean it has to continue, so we have to watch for that. But that's my read on the chart. So take it however you want. I suppose different people see different things in the charts, but ultimately, I think we're going to get continuation to the downside. I'd put a higher weighting on that. Again, my thesis is that we're in a bear market, and I'm looking for price action to confirm that. Thanks, everyone. Leave me a thumbs up. Leave me a comment. Let me know how you, if you're finding value in the content, and I'll catch you guys on the next one.